So studio space, you're going to buy a space to now perform your business out of. You get what we call depreciation, which is just probably on average, the largest tax deduction you can get.
So the business owner should be thinking, how can I actually get some real estate?
Exactly.
And what would the tax savings potentially be?
Potentially paying zero in tax with something like that through depreciation. That's how most of our clients that pay zero, it's through some form of depreciation.
Welcome back to the Think Media Podcast. Sean Cannell here, and I can't wait for today's featured conversation with Matt Bontrager, talking all about some advanced tax saving strategies, some YouTube tax loopholes, and some things you should know as a content creator, as someone who is starting or building their business here in the creator economy, about how you can ultimately keep more money and deploy more of your money towards scaling your business and making a greater difference in the world. Now, today's episode is brought to you by thinkcpas.com. That's thinkcpas.com. And that is actually Matt is who we work with from TrueBooks as our own CPA. That's just if you want to get in touch, because a lot of people have discovered that Matt and his team are amazing, and especially for you and me. Meaning content creators that are dealing with unique challenges that we have as people earning money from YouTube or affiliate marketing. And then also people that want to be intelligent in how they're investing their money, specifically in real estate. Now, if you're meeting Matt for the first time, Matt is a CPA licensed in Nevada and the managing partner, co-founder of TrueBooks, an accounting firm specializing in real estate. And it's actually through Matt's advice that as Think Media and our business started to do well, that we also started to deploy and invest dollars in real estate, and specifically in short-term rentals. And Matt's going to be touching on that in today's episode. And Matt also strives to help clients navigate complex tax code to their benefit, as well as keeping their accounting records organized and up to date. He's also a content creator. He's an in-demand speaker for events, masterminds, and small groups of business leaders and teams. And I can't wait to get into this episode. Now, if you haven't heard episode 1, that's here in the archives, wherever you listen to the Think Media podcast or watch. But episode 2 is really going to cook your noodle, because Matt shares 5 specific advanced things. And then towards the second part of the episode, we answer a couple audience questions and we get into some nuances. I know this might not be your favorite episode on the podcast. There's other cooler things to talk about. But honestly, I feel like this is one of the best episodes you could possibly listen to. Maybe share this with somebody who needs this information, and maybe take something out to listen to take notes with, and to maybe listen to this once or twice, because it's kind of like we're going to school, but school is cool. The more you learn, the more you earn, and that definitely is true about this episode. So let's cut over to the featured conversation. So we're back in episode 2, talking about some YouTube tax loopholes and some advanced money-saving tips for content creators, small business owners, online business owners, and really how you can pay less taxes legally. And so we're going to be diving into a couple strategies. I also have some couple questions to take some of these tactics a little bit deeper. As a reminder, this episode is brought to you by Think CPAs. That's the letter CPAS.com. Think CPAs. That's just a chance if you want to work with Matt and TrueBooks. But we also have other resources we'll recommend because this can really put some money back in your pocket, more importantly, back in your business. But I'm going to walk you through a couple of these 5 tax strategies first, and then we'll get into some nuances. The first big one is starting an S Corp. Why is that powerful?
Because now you're taking the LLC, or you're starting an LLC that you never had, and you're taxing it as a separate entity to the IRS, which we can dive into now, or if we want to go.
Yeah, no. So break that down for me. So when I do an LLC, all I get is a limited liability company. I have some legal protection. If I'm just a sole proprietor or an LLC, I could take a lot of deductions and write-offs. But what's unique about an S Corp that saves me more taxes legally?
Basically, when you're self-employed, you pay self-employment tax, which is about 15%, we'll say. When you're a W-2 employee, you pay 7.5%. Your employer pays 7.5%. If you're self-employed, you're both, so you pay the entire 15%. The S Corp is a great way to lower the amount of the 15% tax that you have to pay.
So if I establish an S Corp, what kind of tax savings could I experience if I was making, say, $50,000 a year as a self-employed YouTube creator?
50,000 would probably save you easily $3,000. Because the example I use most of the time is about 100,000, and will easily save somebody making 100,000 6 to 8 grand.
So simply by setting up an S corp and then running things properly, I could save $3,000 that I would not be paying the IRS, that I would legally be just keeping inside of my business, or keeping myself personally at the end of the year with less taxes.
Exactly. And I want to make it even easier. It's not even setting it up. It's simply a form that your accountant files telling the IRS, your LLC, I'd like to treat it as an S corp. Think of an S corp as this hat I'm wearing. It's just something that your LLC now is treated as. So it's, you already had the LLC. You're just telling the IRS, hey, I want you to treat this LLC as an S corp.
Wow. Okay. So that's a powerful one. Number 2, set up a solo 401k.
So solo 401k is great. That's if you're going to go the retirement route, right? So if you're about stashing some money away for your future, a great way to get a big tax savings. So you make 100,000 solo 401k. Let's say you want to put away 40,000 bucks. I can now be only taxed on 60 because I put 40 aside.
Wow. So this also, if I start to have employees, I can't do this, correct?
Not a solo K, but you can have a 401k plan where you offer that benefit to them too.
But if I'm truly the only person working as that YouTube creator, I might be working with contractors, but I'm just working by myself. I can now sock away big amounts of money, which I'm not going to pay taxes on this year. Now, I will pay taxes when I take it out and I retire, but I am kicking the can by not paying it now when I sock that money away.
Exactly. Unless we get into a Roth solo 401k.
And also, if I could be putting money in my solo 401k and my Roth IRA as well in the same year, right?
Yep.
Okay. And then, so solo 401k. Number 3 is studio space. What's that?
Because of the magical word depreciation. So studio space, you're going to buy a space to now perform your business out of. You get what we call depreciation, which is just probably on average, the largest tax deduction you can get.
Got it. And so would this mean if Think Media bought a building here in Las Vegas, maybe we buy a house with no HOA so that we can just kind of do whatever we want with it and we just devote it completely to the business, or we buy, something that's more zone commercial. The key is we have to purchase it.
Yep. You have to purchase.
So we actually are purchasing a building or a small building of some kind. And now I'm able to depreciate that. So the business owner should be thinking, how can I actually get some real estate?
Exactly.
And what would the tax savings potentially be?
Potentially paying 0 in tax with something like that through depreciation. That's how most of our clients that pay 0, it's through some form of depreciation.
Got it. So just to kind of put a little nod to that, some people get mad when they say big people, former presidents pay 0 taxes. Grant Cardone pays 0 taxes. It's because of real estate and depreciation.
100%.
Gotcha. All right. Number 4 is the SRT loophole. What's that?
Short-term rental loophole. This is by far the hottest tax strategy out right now. So if you are in the game of investing in real estate, basically you can buy a short-term rental with all debt. So meaning you put no money down or you put a small amount down, and again, through depreciation, be able to take this big loss from this short-term rental and net it against your business income. So you have a YouTube business doing 100,000, you buy a short-term rental over here that gets you an $80,000 deduction in 1 year. You now effectively made 20,000 on paper when you really took home 100.
So this is where your genius, this is why we work with you too, is because where your genius comes in, because this is an advanced episode for content creators. The assumption is probably at this point now, money's coming in.
Oh yeah.
And what can happen in content is once really momentum picks up, maybe a lot of money's coming in. So now you're in the higher and higher tax brackets. Maybe you're in the highest tax bracket. Plus you have money to invest. And so you're saying the short-term rental loophole is if you're being a smart content creator, you're not just letting all that money sit or just spending that money on a bunch of stuff that's not write-offable.
Exactly.
That's not a deduction. But if you're smart, you're going to take the earnings and invest it in something intelligent. And if you invest it in something that's a short-term rental, VRBO, Airbnb, there's a litany of tax advantages that could happen there. But one of the biggest ones is that you're able to take a loss. How long could you take a loss on it?
Every year. That's what all these big guys are doing.
So actually it might just continue to take a loss because your business over here is netting $50K a year, $100K a year, multiple hundreds a year.
10 million a year.
$1 million a year. And so you're able to take a loss and build up a real estate empire theoretically, and that's by doing short-term rentals. That's amazing. All right, number 5, and then I want to get into some questions that came in, and we'll unpack some of these things. Your number 5 strategy, that's kind of advanced money saving tips, is bonus depreciation at 100%. What does that mean?
So at 100% means right now, if you bought a large asset for your business, a big piece of equipment for $10,000, you would be able to potentially depreciate or expense 100% of that asset. The reason 100% is so serious is because it used to be 50. So similar to meals, right? It used to only be 50% of that deduction that you would get. Now it's 100, and that actually phases out with the recent tax changes 20% per year. So next year it's going to go down to 80.
Okay, so what qualifies that could be written off with bonus depreciation?
Large assets like cameras, equipment, vehicles, pieces of real estate, things like that.
And so in the past, what the IRS would say, you need to depreciate this over a number of years. What bonus depreciation or accelerated depreciation means is you're taking 100% write-off in the same year. So here's the mindset that I would recommend listeners be thinking about. Let's say there's you and there's a competitor. And not that everything's about competition, I'm not even saying that, but you wonder, why is the person next to me going so much faster? If everything about our business is kind of the same, we're roughly getting the same views, we're roughly putting out the same amount of content, we roughly are doing all the same things. But you only have so much, and we're making the same amount of money. Well, one business owner thinks, I want to use this money smart, and I want to reinvest this money in my business at an accelerated level, and I want to invest in people, at like new gear, new laptops, new equipment. I want to invest in real estate. I want to invest in cars, vehicles for the business. And the other person just goes, oh, I'm kind of afraid of making an investment. Well, they're going to get taxed hard regardless. But now you fast forward 2, 3, 4 years. The person who did this now has 2 studios, 4 cars, and they're further along. Whereas the other person just paid the IRS more money and didn't expand their business at the same rate. Mm-hmm. So the mentality, this is how like higher level entrepreneurs think, is they're thinking about, okay, these are some advantages that I have when I save money because I set up an S Corp. Retirement's a little bit different, but nevertheless, like you're setting your family up, you're setting yourself up for later. But when I go S Corp and I go studio space, and you go SRT Loophole, this is one of the things we think about. One of our team members, as we're recording this, is staying in our Airbnb, which hopefully is greater incentive which, by the way, we're actually making no money for it. But nevertheless, we have this asset because we want to bless them. But hopefully, Think Media is a super cool place to work. You got perks, you got incentives, you got, you get to be in Seattle. You're staying they're also driving the business car. Mm-hmm. And so ultimately, our world is expanding because we are thinking this way and using S Corp, studio space, bonus depreciation. Is that the right way to think?
Exactly. Every dollar you spend, I think, should fall within one of 2 buckets: to grow your wealth or to push your business forward. And there's a ton of ways to do that at the same time. So I would honestly say you could fill both buckets if you spend your money the right way.
Amazing. All right. So kind of in part 2 of this conversation, and then we're also going to be doing a whole 3rd episode. And if you missed part 1, that's foundational. The 3rd episode, we're going to do more Q&A. But a couple questions that came in that were specifically related to this. And if we take it all the way back to the S Corp, Joanna said, if I'm setting up my S Corp, the reason you're going to save money on taxes is because you're going to set a salary to yourself lower, right? Mm-hmm. Because if you just have a full 100K come in and you get the full 15% on that entire amount, then that's $15,000 in self-employment taxes. Whereas by having an S Corp, the difference is you're assigning yourself a salary, and then you're only going to pay the 50% on a reasonable salary. So the question she asked is, what is a reasonable salary to assign to yourself?
Most of the time we would aim to do 30 to 50%, right? Some could be higher, some could be lower. That's where your CPA is going to help you find that value, because what do you have to do? Market research to see what is someone else similar to this job. What are they making? What would a company pay? So in that example, $50K.
Okay.
30 to 50.
So in that case, you make 100K, but now because you set up an S Corp and you are only assigning a salary of 50K, you literally just save $7,500 because you're going to pay 15% on the 50K salary to yourself, but the rest of the income is related to the business. That's serious money. That is $7,500 back in your pocket because of setting it up right and then assigning a salary to yourself. And this is also why it's key. The reason we work with Matt as well, we keep great records and we work with Matt, is should the IRS come to us and audit us, we're like, call Matt, dude. Like, talk, because and the reason you're also you take your job very seriously is that, like, you need someone else, because if we're in a fish bubble and just making it up, we're going to probably make mistakes. And so I like what you said. The person you're working with is going to help you determine what's reasonable, what level you're at. And the nuances are different. Like, things change, you go to higher levels. Okay. And then does that change how you file your taxes?
It does. That's one of the biggest differences now from going from, let's say, sole proprietor, single member LLC, which is meaning you just own an LLC yourself, to now an S Corp. You do have a separate tax return.
Got it. And does S Corp, do you have to pay estimated taxes?
You do. Even when you're self-employed. So no S Corp, you still have to pay your estimated taxes.
Got it. Now, do some people just not do it?
All the time. We have a ton of clients that do it. Think of it as, right, it's 0.5% is the interest or the penalty that the IRS charges. So think of it as 6% annually is what you're going to owe as a penalty to borrow that money.
And when are estimated taxes as a business owner due?
4 times a year, each quarter.
Yes. Okay. And so yeah, it's a whole thing, but something to definitely stay on top of. And so Joanna asked, how much could I potentially save on taxes? Well, for round numbers, if at 100K a year as a self-employed YouTube creator, business owner, you pay yourself 50K as your assigned salary, you're going to save 7,500 on taxes. And then she's asking, is that actually the best structure for my organization? At what level would maybe a different structure be reasonable?
If you are making a couple $100,000 net and you don't plan to take a lot of the money out of the business, a C Corp could work too.
Yeah.
But most of the time C Corps don't work is because you get what's called double taxation, where the business is going to pay tax, and then when you distribute it to yourself, you're going to pay tax. So that's usually not the route to go. But if you're just a cash cow and you don't plan on needing that cash and you want to leave it in the business, C Corps have a flat tax rate of 21%. So it may make sense sometimes if you're going to really generate a lot of cash to just leave it in the business and not pay tax. Because notice what I said there, in a C Corp, you can leave money in and you're just hit with the 21%. S corporations, a lot of people ask, hey, my business made 300 and I only took out 100. Am I only going to be taxed on the 100?
It's pass through.
Pass through. You're taxed on it all.
Yep. And so that's what happens to us at Think Media. When the clock strikes midnight, when it's December 31st, once we go to January 1st, if we didn't buy the car, buy the short-term rental, get the laptop, if we didn't do it, then it doesn't matter whether we leave it in the business or take the money as a draw. We are hit with taxes.
Game's over, new game started.
Game over, new game started. So that is why we also like to think far ahead, and why sometimes, especially in December, we're like, what's relevant? Sometimes this goes more into advanced tax planning and strategy, but we invested in marketing. There was a company we wanted to work with. It was actually wasn't really marketing, but it's kind of marketing related, and it's kind of it has to do with Heather's book project. It's a big expense. I think it was like $80,000, and they had the opportunity to pay quarterly, and I was like, we want to pay the whole thing.
It's one of the best strategies, prepaying expenses.
Yeah, we wanted to pay the whole thing in December because we're constantly cooking. And now that exact thing is, again, you go a competitor, someone next to us, they might say, oh, that's a lot of money, but at 37%, we just saved what? $35,000 back in our pocket that was able to invest towards that. So if someone else is maybe waiting, we are accelerating, especially, we want to pay that whole thing in full. We want to get that thing paid off this year. And so that we can then, and actually we are still executing on that deliverable from them all year long, but we were able to prepay. Okay, that's great. Now, Arden asks, in the first year of doing YouTube, the amount spent will likely exceed income. So how am I deducting expenses in this situation?
So if you used QuickBooks and you made $2,000 throughout the year, you got deposits, you've hit them as revenue, you're going to show $2,000 on your P&L. But then you've bought cameras, you've taken clients to dinners for meals, you've traveled, you've went to seminars, you bought education, you're part of mastermind groups, and that has equated to $6,000. You've lost $4,000 that year. Income $2,000, expenses $6,000, you've lost $4,000. On your tax return, I would put that, and you would show a loss. And if he does work another job, those are going to net each other out, and it's going to help him pay less tax. So right there, it's the best strategy for startup businesses. You're likely going to lose money in your first year. Take the tax advantage.
Can you carry it over at all? Any losses?
You could, but it's very likely he'd get to use it.
Got it.
So
because
carrying it over is that NOL, net operating loss.
Got it. Because so you're probably early on, most people listening to this, if you're in that side hustle season, you've got your main job, your W-2 income. The benefit of your first year of doing YouTube is actually to deduct your expenses against, and it's understanding that there is a lot of expenses that can go. You can sure start YouTube with just a smartphone, just hustling on a library internet connection.
You can run lean.
Yeah, you can run super lean. But some people, they want to really invest. They treat it like a business. I want to go to the event. I want to network. I want to get on the plane and go film a podcast with somebody, a video podcast with somebody. I really want to invest in things. You could do all of that. So then his next question was, how much documentation is needed to prove expenses?
So at the end of the day, an invoice for what you paid for is going to help. So that flight that you took to travel to do your podcast or to film for YouTube, I would keep the itinerary, right? Whatever receipt you have. Data is so cheap nowadays, just save it as a PDF on your computer.
Yes.
You know, something like that. But at the end of the day, just some form of receipt for what you paid for is what you need.
Is there any benefit? Do you think that my Google Calendar has any value? Everything I do for the last 6 years is on my Google Calendar.
Same. Huge. It's huge value.
Yeah. So where I was and then why I was there. So it's like, flew to Miami, went to Mastermind. So clearly, so even if you were, that's another angle of like, what was this expense in that particular?
To hammer that point, if we were an IRS audit and something got questioned for that date range, let's say travel.
Yeah.
And you had a full-blown agenda tied to your calendar, I would legitimately screenshot your calendar and include that in documents that I send to an auditor. That's how important and easy it can be.
Which is a win-win-win, because that's like some Heather Torres energy on terms of like, you should be organized on your Google Calendar anyways. What are you doing? So to put it another way, right? You might, if I fly to Seattle, I might say, I could even put on Google Calendar, we're going to be like looking at houses, doing research, because we are real estate investors now in the sense
meeting
of
with brokers.
Yeah. Meeting with brokers. And then also having to maybe visit the house or do some repairs or go whatever. So just if you are naturally planning your day anyways, just doing that on a week-to-week basis, fast forward a couple of years, it's all there in your Google Calendar.
And we're going to get into something that really touches on this, which is called material participation, which is tied to that short-term rental loophole. But there's literally part of that tax code where you have to track your time. We have time logs that we give people, and what better way to track your time than a calendar?
So break that down. And this is like probably the juiciest nugget for me personally, because what we realize is step one, start your business. Step two, get your business profitable. Step three, have your business doing relatively well. Think Media is doing pretty well and has a good net income left over. And so we start thinking, how can we invest in the future? How can we also expand the empire? And so we purchased an Airbnb. The key being, you also could invest in long-term rentals. However, if you're not actually a real estate professional, which at this point I cannot qualify for, I work too many hours in our business.
Yep.
The loophole is the fact that you get the benefit of a real estate professional, even though you are not one.
Exactly.
But the key is you have to be materially involved. What does that mean?
Materially involved is basically with regards to that activity being the rental, the Airbnb, you run it materially. The time you spend on it is needed to push that Airbnb forward and to have it operate. And basically that's because rental real estate is looked at by the IRS as very passive. It's sit back and collect a check. So if you can meet these rules and have a short-term rental, which by definition avoids the definition of rental activity with the IRS. That's why it's so important and needs to be short-term. To be more specific, it has to be on average 7 days or less. So the amount of time you rent the property for your average stay needs to be 7 days or less. And then if you spend time on the property and materially participate, you can avoid the other rules and take this and generate this huge loss from this rental and net it against your business.
And so my wife, she decorated the house. She runs the app. She runs the listings. I took all the pictures for the listings, opened up Canva, did a sky replacement on a picture of the house. So it popped more. We're super hosts now. The whole thing's happening. The big key is we couldn't take this same bonus depreciation and then the write-off against our business if it was a long-term rental.
And that's where look at it as a game, because by definition, that's how we're avoiding and making this somewhat of a loophole. I honestly think the IRS will close this. They're going to see what's going on, and it's not going to be around for a long time.
Makes sense. And so definitely speaks to the hustle that we're on it. Last kind of question here is also from Arden. So he is writing off. He's taking a loss because his expenses exceed his income in that first year or two of starting up your YouTube business. You keep good documentation. We did talk about this in episode 1, but just to hit it in episode 2 here, how much revenue is recommended before converting from a sole proprietor to an LLC? In some states, LLC fees are extremely high, but there's actually advantages to just buying like influencer insurance to cover liabilities.
Fair. So that's where in the last episode I had mentioned, and I'll stick to it, as soon as I'm in the pursuit of income, I'm going to get an LLC. Why? Because it also allows me to get an EIN, which is like a social security number for my business. And then I get a business bank account. Those are the first 3 steps.
Yep.
LLC, EIN, bank account. But he's right. If you want to, let's say you live in California and you want to avoid that $800 a year franchise fee. That's a lot of money for a new startup business. Then I would run as a sole proprietor, which is me doing business as myself, and maybe just getting insurance, because maybe insurance is $300 a year. So again, I'm a fan of an LLC. I agree with that, though, that you could just run as a sole proprietor. But net income, when that gets around 50 grand, I'm going S Corp, which requires me to have an LLC at that point.
Yes, amazing. So a couple next steps. This was some advanced stuff. Definitely some advice. Number 1, if you haven't listened to part 1, listen to part 1 because that's some more foundational things. You might not be at a place where it's not mo money, mo problems, but once it's notorious B.I.G., you got more money, you got more problems. So you want to learn mo tax loopholes and to pay less tax legally so you can actually solve those problems, because they are solvable, but you got to think at the next level, right? I think another resource that we have for you is if you haven't picked up the recordings from our Advanced Growth Video Live, Video Success Secrets is actually how they're packaged, and we'll put a link to this in the show notes. Matt and Ryan touched on it as well. You did a panel and you did a session where you just broke down a lot of strategy and tips, those kinds of things. Interestingly enough, and I understand that this is an online course that we sell, but I think one payment, it's $247 right now. But that's a write-off too. You're investing in your education. You're going to learn 3 days of marketing information, strategy, money-making tips, how to generate more revenue. That just goes into, it's kind of I'm getting off on a rabbit trail here, but that's why one of my favorite investments is my education, because it makes me more valuable. I can learn more, but I also can write it off. So I like to travel to events. I get the experience, but I get to take notes, learn all the things. All that to say is, again, number 1, listen to episode 1. Number 2, definitely pick up videosuccesssecrets.com, because it's 3 days of all kinds of stuff, including more business and tax strategy. Number 3, connect with Matt on social media, because you're going to need repetition of this. Repetition is not just so that it's also so that you never forget. I have been studying this stuff for over a decade, and I still need to hear it again. I call you, explain to me again, SRT loophole, it's a lot. So if you already feel overwhelmed, we don't blame you. You want to stay immersed in the repetition of this information, always staying current. And that's why following someone like Matt is really important. So if people want to follow you, where's the best place to do that?
Instagram.
And your handle?
At Matt Bontrager. Just first name, last name.
Awesome. So we'll link that up in the show notes as well. And then finally, if you go to thinkcpas.com, so thinkcpas.com, you can actually connect with Matt and the TrueBooks team if you're interested in specifically working with them. If not, cool. You can work with whoever. However, I highly recommend Matt. We have years of experience in friendship now, but because, he is plugged into not just the real estate game, which is where your real big tax savings are, but also the content creation game as him and Ryan work closely together as a co-founder of TrueBooks, and they're just on the bleeding edge. So man, your network is your net worth.
1,000.
You want to be around people who are plugged into SRT loopholes, and then when the game changes, you just go wherever the puck is next. And so definitely the big recommendation is either connect with Matt and his team or find the right CPA and team. It's so worth, scared money don't make money. It is so worth the investment. I don't want to pay a CPA. I just want to go with this person because they're cheap. You get what you pay for. And you guys aren't even like expensive. It's just a good investment. But it's like, I'm looking for the cheapest CPA is not what the successful business owner said. No. I'm just trying to find the cheapest person. No, you want to make sure you have experts. You've got like great people around you. So anyways, we'll link up all those show notes and resources in the description down below. And then make sure you're subscribed because we're actually going to be bringing you a Q&A episode that maybe touches on a few details that you asked in the Think Media Podcast audience. And so thanks again, Matt, for coming on.
I appreciate it. Anytime.
Well, I hope you've been getting value out of this series with Matt. Just a couple reminders. If you haven't listened to part 1, it's here in the archives of the Think Media Podcast. Don't miss it. And also, if you've gotten value in today's episode, would you consider sharing this with somebody who would benefit? There has been probably no greater investment that I've made. One of the greatest investments that I've made in my personal life and my business has been increasing my financial education and my financial intelligence. It's not my favorite thing to study. I would much rather read a book on social media or on how to hack the algorithm or hook point or all these different things. But I found that one of the greatest benefits for me in my career as a content creator and in growing Think Media has been embracing topics like this. And there's probably a few people you know who are unaware that they are overpaying in taxes. They're unaware that there's maybe liabilities to their business in terms of how it's set up. They're unaware of some of the opportunities that exist for them to ultimately set up a better future for their family, to make a better impact in their team, to set up a better future for themselves in retirement. So I really do think that this episode will be super valuable. So think of one person that maybe would love this, and would you consider forwarding this to them? Or just maybe share this on your social media and tag myself or Heather Torres or the official Think Media account. And we'll link all that up in the show notes so we know that you got value out of this particular episode. Finally, if you are interested in connecting with Matt and his team at TrueBooks, just go to thinkcpas.com. That's the word think, the letter CPAS for thinkcpas.com. They're the CPAs that we use, and they've been nothing but a blessing. If you don't want to work with them, cool. But one of the things that I would recommend is we know after years of working with multiple different people, they're the most knowledgeable we've ever worked with, and they're hungry. I think it's the fire that I like the most for staying on the cutting edge of what is happening right now. Because Matt and Ryan Pineda, who's a content creator and real estate professional out here in Las Vegas, because they're doing the stuff, they're content creators themselves, they run multiple channels, they run multiple different income streams, because they're absolutely obsessed with passing any audit and being above board and ethical in all their dealings, but aggressive in terms of learning and understanding the tax code so that they can maximize the savings and use it to their benefit. We get to draft behind them, and we've experienced countless savings. Matt has literally saved us hundreds of thousands of dollars. And I would say if you have some momentum and you're at a place where you're ready to move past DIY, or maybe you're just fed up with your current CPA and you want to work with somebody better, just check out the show notes or go to thinkcpas.com, and they just have a special hookup for Think Media Podcast listeners. My friends, thank you for being a part of the Think Media Podcast. We have so many powerful episodes coming to you soon. But in the meantime, I just want to say I respect you. I appreciate you. Keep pressing record, because there's never been a greater time to be publishing content and building a business around that content as you serve people and build your income. Appreciate you so much. We'll talk soon. See you in a future episode.